All right, exercise number 6. No, 5. Exercise number 5 on page 563. No, those exams are yours to keep. 568. You can do whatever you want with them then. But make sure that I've already got them entered into the grade center before you shred it. Make sure that I've entered it correctly. All right, the condensed single-step income statement for the year ended December 31st, 2011 for Sutherland Chemical Company, a distributor of farm fertilizers and herbicides, appears as follows. And it gives you the sales, cost of sales, net income, as well as the operating expenses include $820,000 of depreciation. They then give you the account balances at the end of 2010 and the end of 2011 for all of the current assets and current liabilities. So the requirement here is to prepare the operating activities using the indirect method. So we have Sutherland Chemical Company. Statement of cash flows. And this also measures activity, so it is once again for the year ended. (2011). So, cash flows from operating activities. Using the indirect method. What's going on here? Oh. Got all upset. The little battery fell off. Using the indirect method, the difference between the indirect and the direct method is indirect starts with net income and then does a series of adjustments, whereas the direct method goes out and calculates cash inflows, like cash receipts from customers, and then cash outflows. All right? So we start with net income. And for this company, it was $1,200,000. We're then going to make a series of adjustments to reconcile cash. Reconcile net income to net cash flows. From operating activities. So, reconciliations on the income statement are any expenses that are non-cash in nature. So depreciation, you spent the cash when you went out and bought some sort of property, plant, and equipment, some sort of tangible asset that you then depreciated. The journal entry at year end or month end is just the debit to depreciation expense and the credit to accumulated depreciation. There is no cash involved. So we're going to add back depreciation. $820,000. You would also add back anything on the income statement, gain or loss, that is not operating in nature. This company doesn't have any. Some of the later ones that we do either today or on Wednesday before we finish this chapter might have a gain or loss. Like if you sold a truck. You sold a truck for a $5,000 gain, like on the midterm. That would be then backed out because it's not operating in nature. It's a investment activity. It's in the next section. All right? So now you just go through and you do changes in current assets and liabilities. So current assets, accounts receivable, started the year with $1,700,000 and ended the year with $2,400,000. So we had an increase in accounts receivable. Now, if accounts receivable goes up, what happens to cash? It goes down, exactly. There is an inverse relationship between current assets and cash. Because this $700,000 is an amount that your customers did not pay you. Does everyone understand that?
So it has to reflect on here inverse?
It's inverse. It's a negative adjustment to cash from operating activities. All right? What about the next one? The next one is inventory. Started the year at $1,020,000 and ended the year at $840,000. So we had a decrease in inventory. Of $180,000. How does that affect cash? Cash goes up. Inverse relationship. Inventory went down. We were not buying more inventory. So we saved the cash. Prepaid expenses went from $180 to $260. We have an increase in prepaid expenses. $80,000. Effect to cash? Down. Inverse. That's it for the current assets. This is the next account that was given to us in this summary balance sheet was accounts payable. So that's a current liability. Accounts payable went from $720 up to $960. We have an increase in accounts payable. $240,000. How does that affect cash? Cash goes up. There is a direct relationship between current liabilities and cash. We have not been paying our vendors. If you don't pay your bills, you get to save cash. It's simple, right? Accrued liabilities. I won't recommend it for very long, but it will save you a little cash. Accrued liabilities went from 100,000 down to 60,000. We had a decrease in accrued liabilities. Oh. Why would it go up? An accrued liability would be accrued wages payable. So we owe, but we've lowered that account. So we don't owe our employees as much at the end of the year as we did at the beginning of the year. We must have paid them, so it goes down. Direct relationship. So any decreases will decrease cash. And then the very last one, income taxes payable, went from 120 up to 140, an increase in income taxes payable. $20,000. Add all that together, the $820 in depreciation plus all these adjustments for current assets and current liabilities, we get a positive $440,000 effect to cash. Add that to net income, we get $1,640,000 as net cash flows from operating activities. Simple. Let's do exercise number 11. It starts at the bottom of the next page and goes to the top of the following page. So exercise number 11 on page 569 and 570. Couldn't agree more. All right, so Bristol Corporation. So this is Bristol Corporation this time. And it is also, and now it's June 30th. I always make it hard. June 30, and this is Bristol. All right, so they give us an income statement which lists net income of $17,900. On the next page, they give us a comparative balance sheet with all of the assets, liabilities, and stockholders' equity for both 2010 and 2011. Additionally, it tells us down in the a paragraph of additional information as to we issued a note payable to buy some furniture. We sold some furniture. That gives us the original cost and depreciation. And it tells us that we recorded depreciation for the year on the furniture that we owned of $19,300. We'll stop right there. So we have a depreciation adjustment of $19,300. We then need to do our changes. In current assets and current liabilities.
Is the 17.9
Net income, correct. Yes, sir. So current assets, not including cash, because cash is what we're reconciling to. Accounts receivable started the year at $26,000, ended the year at $21,000. We had a decrease in accounts receivable. $5,000 decrease. Effect to cash is goes up. It's a positive adjustment. Inventory went from $48,400 to $43,400. We had a decrease in inventory. Of $5,000. So just like accounts receivable, if inventory goes down, cash goes up. And lastly, prepaid expenses, $3,200 at the end of the year, $2,600 at the beginning. We had an increase in prepaid expenses. $600. So if it goes up, cash goes down. Current liabilities, there's only two of them. There's accounts payable, went from 14 down to 13. We had a decrease. Of $1,000. So if accounts payable went down, how does that affect cash? Goes down also. Direct relationship between current liabilities and cash. And then lastly, income taxes payable. Started the year at $1,800, ended the year at $1,200. Decrease. In accounts, I'm sorry, in income taxes payable. $600. Add all that up, you get a positive $27,100 in the adjustment to cash. Add that to net income, you get $45,000 even as net cash flows in income taxes payable. I'm sorry, in operating activities. I'm reading the wrong line. Yes, sir, go ahead. Okay. Cash flows from investing activities. This is any changes in the balance of assets other than current assets. Okay? So the only other asset that they have is this furniture. Furniture started the year at $60,000 and ended the year at $55,000. And the difference between it is they bought some new furniture for $22,000, and they gave a note payable to that. So they had a purchase of furniture for $22,000. And that's a use of cash. You bought furniture. We also sold some furniture that cost $27,000 but had an accumulated depreciation of $15,300. So, what did we sell that furniture for? How much? Nope. You bought the furniture originally with $27,000. It had depreciation of $15,300. So we had a book value on that equipment of $11,700. How much did you sell it for? Because we have sale of furniture. Well, the question is, did you sell it for a gain or a loss? How do you know? Look at the income statement. The income statement on the previous page had sales, cost of sales of goods sold for a gross margin. Then they subtracted operating expenses to get operating income. And then they subtracted some interest expense to get income before income taxes. And then they subtracted some income tax expense to get net income. Is anywhere on that list a gain or loss on sale of furniture? No. So you must have sold it for exactly what the book value was. You must have sold it for $11,700 in cash. Add those two items together, you get cash flows, net cash flows from investing activities. And that is 9,300. Or is it 8,000? 10,000. Ah, yeah. Once again, it's not horseshoes. Yes, sir.
Where did you get like the 11,700 from? Like what page?
Okay, at that paragraph underneath the balance sheet, it says that the equipment that we sold, we originally purchased it for $27,000, but it had $15,300 in depreciation. So that gave it a book value at the time of sale of $11,700. On the income statement, there was no gain or loss on the sale of that equipment. So we must have sold it for a cash price equal to the book value. It's the only way you wouldn't get a gain or loss. Yes, sir.
That's 22 or 27?
22. That's the new stuff that we bought. 27 was the old furniture that we sold. It was the original purchase price of the old furniture. The furniture that we bought to replace it with was 22. All right? So that just leaves us the last section, which is cash flows from financing. Activities.
So is that the end of the statement or not?
Nope, that's the end of section 2 of 3. Because we have operating, investing, and financing. Those are the 3 sections of the statement of cash flows, which are the 3 activities from chapter 1 that all businesses are involved in. Okay? This is the only financial statement that actually follows all of that. All right, so the financing activities is the rest of the liabilities section other than current liabilities. We've already used those. And all of the stockholders' equity section. All right? So we had notes payable, long-term notes payable. That's the rest of the liabilities. Started the year at 35 and went up to 37. However, we know that we've already issued a note payable because we issued a note payable to buy this furniture. So proceeds from notes payable.
No, we're gonna have to use those exact words.
Yeah, but I'm making it easy. Because it's open book, open note. Right? But are your notes confusing? Well, then you got a problem, my friend. You might want to go home and type those notes up.
The final exam is cash flow?
Cash flows and the statement, it's the bond calculation that we just did. Open book, open note. Yeah, because you need those present value tables in order to calculate the value of the bond from the last chapter.
As far as saying notes, now if I were to take a picture of this right here and download it to my laptop,
And print it out. Yeah. Yeah, same as writing it down. But then you're going to be sitting there. I've had students in the past share books, but they seem to get to the same problem at the same time. And they seem to struggle over it. You've got a full 2 hours. So if you're sharing a book, I mean, technically you're supposed to have a book. And I understand. I had a student walk in one time and unshrink wrap his book at the final. And I went, really? I mean, you didn't open the book the whole semester? I mean, come on. Couldn't you have done that out in the hall? So I didn't have to see it? Yes, sir.
Will the final exam be like any longer than a normal exam?
No, but you have longer time. You have a full 2 hours to do it. Yeah, this particular exam is going to be on Monday morning at 10:45 to 12:45. But there's no one in this classroom. So I always come in at 10:30, the normal start of the class. And if you want to start it then, that'll give you 2 hours and 15 minutes to do the exam. I have no problem with you getting the extra time. Okay? Because it's the official exam schedule for this class is 10:45 to 12:45. Why? I've never been able to figure out why. All right?
What day?
On Monday. No, it's finals week. It's first week in May. Yeah. Yeah, we got plenty of time. No, next week. Finals already. No. It's April 11th, for crying out loud. No, we just got a few weeks left. So, yeah, this time next month I will be in Cozumel on the deck of a dive boat. This exact day will be first day of scuba diving in Cozumel. Okay, so are we good with this so far? Proceeds from the notes payable is a positive adjustment for $22,000. Now, it says we also repaid a note in the amount of $20,000. So that's where the note balance went. It went from 35 to 37. So the net was the proceeds and the repayment. Yeah. So that's 20,000. Yeah, we'll all be able to hear that on the video come a little bit later today on YouTube. Everybody will go, who the heck was that? All right, so that's it for the liabilities section. So what happened to stockholders' equity? Stockholders' equity only has two accounts. Common stock went from $90,000 up to $115,000. And it says in the extra little information there that we issued $25,000 of common stock at par value. So we have issue of common stock. $25,000. And that's a positive. And the last section is retained earnings went from $3,700 up to $17,300. So what affects net just gave it away. What affects retained earnings besides net income? You take last year's retained earnings, you add net income, that gets you a subtotal, and then you subtract dividends. Payment of dividends. So how much did we pay in dividends? Does it tell us? $4,300. But you could figure that out also. Because you could sit there and look at the difference between beginning retained earnings and ending retained earnings. Add in the net income, and then whatever it needs is dividends. So the difference between the change in retained earnings, and when I get to the review in the final, because I make you do that on the final, I'll show you that calculation again. The difference between retained earnings, which it went up, versus how much net income there was, is dividends. And in this case, it tells us in the problem $4,300. If you add all that together, you get $22,700. That is net cash flows from financing activities. If you add up the net cash flows from operating activities, which was $45,000 positive, subtract the net cash flows from investing activities of $10,300, and then add the net cash flows from financing activities, you get net increase in cash. So the net increase in cash is $57,400. And sure enough, on the balance sheet, cash at the beginning of the year was $12,500, and the cash at the end of the year was $69,900. And that is a full statement of cash flows to introduce you to. So if you want to take a picture of that masterpiece and print it out and bring it to the final exam and try to read my handwriting versus yours, then you are more than welcome to. Yes, sir.
So we don't have to do anything with the net income?
This one, we used it already.
Oh, okay.
We used it for operating activities. Okay?
And you